Hello and welcome to the new episode of Death and Taxes, a weekly podcast by the private client team at Burgess Salmon. My name is Guy Broadfield and I'm a tax and trust lawyer in the private client team. And together with my tax and trusts colleagues Tim Williams and Edward Hayes, we will discuss a range of issues facing clients and professionals alike. Each episode will be joined by specialist lawyers from around the firm to bring you our views on important topics for private clients. In today's podcast, we'll be talking about issues for landowners to consider when selling land for development. And Tim and I are joined by Ross Simpson, a partner in our real estate team. Ross is dual qualified in Scotland and England and regularly advises landowners on contracts associated with complex strategic land work. So it's one of the long-stated aims of the government is to try and solve the current housing crisis. And that is really to try and build more homes, to help get the next generation onto the housing ladder, and allow the most vulnerable people in society to get homes. And so with that in mind, the government has promised to build 300,000 homes a year. And that is an aim that has cross-party support on a political level and doesn't really seem to be going anywhere. So it's an important part of government policy for many years to come. And so the purpose of today's pod is to really talk about how that might affect landowners and in particular landowners who might own so-called strategic land. And so really the first question, Ross, is when we talk about strategic land, what do we mean?
Yeah, no, it's a really good question, Guy, and just making sure we understand the language that we're using. And so, yeah, what do we mean by strategic land? How does it differ from, farmland? Well, typically, when we're generally speaking, when we're just talking about strategic land, we mean greenfield land. It's typically farmed and that has development potential, typically residential development, in the medium to long term. So it's land that's not currently allocated within the planning system for, say, residential development, but there may be potential in the medium to long term. And classically, strategic land, or the land that has most strategic land value, will be that land that sits on the fringes of existing settlements, villages and towns. And yeah, typically, that's what we mean by strategic land.
Okay, thanks, Ross. And I guess the need for strategic land to be developed remains incredibly strong in the UK for the political reasons we talked about. And it also, for the individual, represents perhaps a once-in-a-generation opportunity to, release cash funds from perhaps long-held land in that sense. So what happens if, let's take an example, say I'm an individual landowner and I own 400 acres of strategic land and I'm approached by someone who wants to build on my land. Where do I go to? Who should I go to? What happens then?
Yeah. No, another very good question. And there's a lot to that. And I think the first thing, the starting position has to be, well, who is it that's knocking on the door? Who is it that's making the approach? Are we talking about a developer, promoter? And there's quite, there's a distinction to be made there. A developer, typically, your house builders of the world, your Taylor Wimpey's or your Persimmons, they will be approaching, looking typically for landowners to sign up to what we would refer to or describe as an option contract or an option agreement. And it tends to be the type of agreement people are most familiar with, where the developer is given the opportunity to promote and secure planning for the land, and then once it's obtained planning, the developer has the sole right to purchase the land, and then sale price will typically be calculated by reference to a formula built into the contract, normally based on prevailing market value at the time that the option is exercised, and that's going to involve some kind of technical valuation being done. So that's the one road that you might be going down, but alternatively, it could well be a promoter that is coming knocking on your door. And essentially, it follows a very similar course as the option agreement, but that's only up until the point that planning has been obtained. And at that point, instead of your promoter purchasing or having the ability to purchase the consented site using some kind of market value formula built into the contract, both landowner and promoter will take the land to market together. They're going to decide on a marketing strategy, how best to market the property, and then the consented site is sold on the open market to the highest bidder. And then out of sale proceeds, there's either a reimbursement to the promoter of costs incurred in promoting the site, or there's a percentage of sale proceeds paid to the promoter, or a combination of both of those things. And yeah, in a promotion agreement, you can see there the landowner, the developer or promoter is on the same side of the table, bringing the property to market. So yeah, there's a range of options that might cross the desk depending on who's making the approach. But yeah, these are fairly big opportunities, and once a generation opportunities, really considerable rewards that come out of them. So it's really important that getting the right deal choice and robust professional advice is going to be a really important part of that.
I suppose, Ross, is it right to say that along with those big rewards comes a lot of risk and a lot of costs? So I mean, I'm guessing that this isn't the kind of scale that we're talking about in the strategic land context. A landowner doing it themselves probably isn't really possible here.
Exactly.
You need very deep pockets. I mean, because I guess we're talking sort of homes in the tens and the hundreds rather than your 4 houses on the side of the farmyard.
Well, certainly if you're talking about a 400-acre site. So yeah, the costs are going to be frequently far too prohibitive for most landowners. There's some out there, and there's definitely good landowner-led development out there, but for most it will be prohibitive, and the number of developers and promoters out there that are willing to assume that cost are fortunately plentiful, because there is this housing shortage, and homes need to be built.
And I suppose just thinking about the sort of different motivations of the developer and the promoter. I mean, the developer makes their money when they sell houses. So what the stock that they want to get in is the land, and they want to pay as little as possible for that land, and then build their houses on it and sell them on for a good price. But I guess the promotion agreement there's more alignment there, isn't there, between the landowner and the promoter, because the promoter gets paid on the basis of eventual sale price. So the promoter and the landowner are as you said, on the same side of the table. And
it's definitely, that's generally viewed as an advantage of the promotion agreement, that both parties should be sat on the same side of the table. The thing to watch out for, though, is the percentage share of the sale proceeds that a promoter will typically want under promotion contract will generally be higher than what the developer discount might be under an option contract when coming up with your kind of price formula under the option deal. So the promoter's not going to be generating any development profit from this scheme, because we're taking it to market together and selling it on. So they will be looking for that higher return through the promotion fee.
So I suppose it's not to say that one is necessarily better. It's going to net more value for the landowner. It just might be a slightly different process, pros and cons on either side.
Exactly, and then there are pluses and minuses. You really do need to look at it in the round to see what's the best fit for the landowner, for the site, and where there's maybe a particularly large site. You might be looking at, there's a third option out there, probably too much to go into in today's session, but there's the hybrid agreement, so-called, because it has elements of both the option and the promotion, but they may provide some answers on particularly big sites.
So however these returns are generated, I mean, the landowner is likely at the end of the day to be in receipt of several millions of pounds. And with that reward comes quite a lot of commercial and tax risk. So I mean, whilst there's a huge commercial substance to these arrangements, it is really important to get the tax piece right as well. I mean, as a tax advisor, that's exactly what I would say. But I think it's important when you start thinking about your development or promotion agreement, or your hybrid agreement for that matter, that actually it works from a tax point of view. Now, in our individual landowner scenario, they're going to be very concerned to make sure that everything they get in is taxed as capital, so taxed to capital gains tax when they sell. I mean, we're in a little bit of flux at the moment because we don't know what changes or increases there might be to CGT rates. But at the moment, as we speak, there's quite a big difference. If you tax at income rates, it's 40-45%, or capital gains tax at 20%. So if you're an individual landowner, you really want to make sure that you're paying capital gains tax. So what that means in sort of terms of the deal is that there are some things to watch out for. What some developers will quite like to have is what's often called a slice of the action scheme, and that means that rather than an upfront payment, you might defer some of that gain for when the developer actually sells some housing land, and it's a sort of, so you take a share of the development profits. And commercially, that sounds great because there's money coming in on when houses are sold, but actually the landowner will probably pay income tax on that money rather than capital gains tax on the sale of the land to the developer in the first place. So slice of the action schemes are certainly to be avoided. I mean, another thing to watch out for in that in that context is structural changes and changes of ownership ahead of a development. And that's due to something called the Transactions in UK Land Code, which is an absolutely horrible piece of legislation. But broadly, what it does is treat what would otherwise be a capital transaction as an income transaction where certain criteria are met. And that's often around why land has been acquired or how it's owned pre-sale. So things to beware of in the background.
We sometimes see it, Tim, on some of the developers' rights they want to see under some of these contracts, that we are exchanging the ability to come in and do stuff on land during the period of contract prior to sale. And yeah, there's that tax problem around possible trading in land status that is really important to be wary of.
Exactly. I mean, what we'd like to see from a tax point of view is the developer not really coming on the land at all, other than to do surveys and things, until they've actually bought it. Because as you say, Ross, if you start to do things on the land that look a bit like development, then you as landowner may find that you're hit with an income tax charge when you come to sell that land. So that's really important to know what the developer is going to want to do in terms of access ahead of an actual sale going ahead. And I mean, the other thing here from a tax point of view is, as Ross said, it's a long and winding road. This can take a very long time from getting your developer, your promotion agreement in place and actually selling any land. And during that time, the landowner needs to make sure that they're going to qualify for the inheritance tax relief they would otherwise get. So if that's business property relief, making sure that your structures will work properly. If it's agricultural property relief, making sure that the right person owns it and farms it. Remember as well that there's also entrepreneurs relief or business asset disposal relief, as it's known now, to play for when land sells. So whilst that's less valuable than it once was, it's still worth making sure that if land is traded, if it's trading land, that you get your sales structure right to make sure that you can obtain that relief as well.
Okay, well, thanks, Tim. A lot of important tax considerations for individual landowners there. I mean, to go back to our earlier example, let's say rather than having or owning 400 acres, I am a landowner that owns 100 acres, and my neighbouring landowner has a further 200 acres, and together we can put forward a really interesting proposal for development, whereas individually we can't. How does that work in that case? How do we as landowners come together and put something together that works?
We say it's not uncommon, is it, for land, particularly around the edge of towns or villages, to be owned by more than one person. So landowners do need to work together with their developer or promoter. And they also need to work out how they're going to share the rewards when land sells. So it can often be a little bit uncertain where value is going to be realised, and where development or planning consent even is actually going to happen. So the landowners need to be alive to that, and what they'll often do is agree to share the sale proceeds as it comes in. So if I've got 100 acres, I agree when I sell an acre of my land, I pay 20% to my neighbour, and he does the same. So we share value in that sense, and commercially that makes sense. You're sharing the risk, you may as well share in the rewards. But there's quite a lot of detail that needs to be worked through in those arrangements, not only because it's a commercial deal and that's the primary driver of these. It's really reflecting the commercial reality here. The landowners can't do it alone. They've got to come together. So they need to agree a fair way of sharing proceeds, but they also need to actually agree how they're going to deal with the promoter and the developer. Who's going to make decisions around what prices they accept and how they push the planning forward and all that sort of stuff. But again, a bit like with the sales themselves, there's a big tax piece to the equalisation arrangements as well. And because that in my example, my 20% payment away to my neighbour needs to be deductible for capital gains tax. I don't want to have to pay tax on the full amount coming in if I'm then paying 20% of it away. So there's quite an important tax structuring piece there as well, which is probably beyond the scope of today's discussion, but needs to be thought about early in the process.
And yeah, just on that, Tim, I think it's probably in the context of these sorts of multi-landowner deals, that you and I have to work most closely when it really requires looking at the issues from the tax perspective, the real estate contract perspective, and making sure that we are as joined up as we possibly can be. I think that's where we, working together, really are able to add value.
Absolutely, yeah.
So I think from both what you said, Ross, and your comments, Tim, it's clear that this is not your standard real estate transaction, in terms of complexity, planning, tax consequences, and everything that flows from that. I mean, what would be your takeaway point, Ross, to anyone in this position?
Takeaway point for me has to be, the rewards can be exceedingly great here, but only if the deals are set up right. The difference between the value of agricultural land and development land are enormous, and it's really important. If that value, if you're going to capture it right, the deal needs to be set up right. So be sure to be taking robust professional advice at the outset.
And then, Tim, from a tax perspective, clearly very complex area, but is there anything you can distill down for us in a short conclusion?
I think it's probably echoing what Ross has said, really. I mean, the rewards are big, which means there's lots of tax at stake here. So whilst those the deal structures are being negotiated, having tax at the front of your mind and getting the tax advisors in early is really key, because otherwise you can very easily trip up and end up with an unfortunate tax consequence.
Yeah, and I think it's interesting. On previous podcasts, we've talked about liquidity events in the context of family-owned businesses and for entrepreneurs, and clearly that's a life-changing moment for those individuals. And here, what we're talking about really is a liquidity event for landowners with equally significant sums. But I guess there are some fundamental differences, aren't there?
Thanks again for listening to Death and Taxes, a private client podcast from Burgess Salmon. You can find out more about Burgess Salmon and our team at burgesssalmon.com or on our LinkedIn page. This was the last episode in this season, but we'll be back with season 2 shortly. But in the meantime, do keep an eye out for special editions of Death and Taxes.